Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm so excited that you're here today. We are going to be talking about investing in real estate without tenants, toilets, trash, and termites. But before we dive into that topic, if this is your first time attending the Passive Investing Made Simple show, welcome. We do this show live every Tuesday to help you learn about the ins and outs of passive investing. Also, just so you can get more confident with, crafting your portfolio and growing it. So if you haven't done so already, make sure you go to passiveinvestingwithwhitney.com and register for future masterclass sessions. You also get notified of our skills boot camps that we do on a monthly basis. You'll also get access to my free ebook, Passive Investing Made Simple, my calendar, as well as priority access to our open deals. So you can find that at passiveinvestingwithwhitney.com. Now let's dive into today's topic. Today's topic, we're talking about investing in real estate without tenants, toilets, trash, and termites. Now, most people would be like, yeah. When you're talking about syndicated investments, we get that. Actually, that is just one little thing that we are going to be talking about today. We're going to walk through several questions that help us understand if investing in real estate without all of these things is actually the right course for us. Now, if this is your first time meeting me, again, my name is Whitney. This is the whole reason why I invest in real estate. And I kicked off building my portfolio very actively. I bought a house with a significant other. The relationship fell apart. I had the house, and so it needed dire rehab, stuffed it full of roommates, completed the rehab on that property, and was completely bitten by the real estate bug when I sold that about 11 months later. Realizing that I actually made more at that project on nights and weekends than I did at my day job that had me traveling upwards of 80 hours a week. So if you know me, I'm like dive in head first, trying to figure out all the different ways that I can scale my portfolio in real estate. Have scaled actively through building a portfolio of 36 single family properties. Bought the 52-unit apartment building, have gone into general partnership on 10 multifamily properties. I've raised on over 29 projects, and all those things are very active involvement in real estate. Now, here's the thing. I have chosen to take a lot of those active activities and take that money off the table, much like you could do in your day job now, and what I encourage you to do, and shift that over into building streams of income that don't require your involvement. Now, that is what I call like true wealth, because that is what has allowed me and my husband to have 100% choice and control in how we spend our time. And we can actually help you do that here at passiveinvesting.com. Now, fast forward today, my husband and I, we have over 6,500 multifamily units within our portfolio in partnership, 2,200 self-storage, 15 car washes, and a myriad of other investments. And we do still have some of our own active investments where we are having to handle those tenants, termites, toilets, and trash on a fairly regular basis. But majority of our portfolio is scaled up of those passive assets that allow us to have that 100% control and freedom on how we spend our time. And as I mentioned already, we can help you do that here at passiveinvesting.com with our 1.4 billion assets under management, strong returns to our limited partner investors of 28.9% ARR on our full cycle deals, and over $51 million distributed to our investors. And that's just as of September 2023. Now, what we're going to go over today, as always, you're just going to put it out there. This is not advice, legal advice, tax advice, financial advice. Make sure, as you are considering these strategies, that you are consulting with your investment team before participating. Now, into our topic. What do I mean by investing simplified? Well, when I talk about investing simplified, I'm really talking about how can you invest in real estate with minimal risk and with minimal hassle. All right. Now, I started off scaling, once I, was done doing a large part of the fix and flipping and house hacking Those were very active ways of being involved in real estate. I decided to start scaling a portfolio of single family properties and placing them with property management. Now, I don't say that that's investing simplified. I think it's very leveraged. I was able to amplify my time, but I was still largely responsible, or actually entirely responsible for, sourcing the markets, for those deals, putting together the teams of realtors and lenders, securing the deal, putting it under contract, doing all the underwriting, due diligence, securing the loan. And then that was just to get the property closed and then place it with property management. Okay. And that was a big, heavy lift. Now, I'm glad that I did it, but I also, if I had known better, I probably would have launched into scaling passively much sooner, because there are no gold stars for, nobody, you don't have to buy your own single family rental properties to understand real estate before you start investing passively. So that's where it really kind of dawned on me. Like, I was several years into scaling the single family rental portfolio, I hit a level of achievement. Um, I was still working my day job. So was my husband. We had a small child at home. I had two ailing grandparents that I was their guardian. And then my mom was also in failing health as well. And so, here I was scaling a portfolio that was supposed to be giving me time back. And it was actually taking more of my precious time from me. So how could that was my biggest question. How could I still leverage the power of real estate, but get rid of all these headaches? Like, tenant vacancies at the wrong time of years, toilets breaking. And I know we say that kind of tongue in cheek, that toilets are a problem, but, water problems on property have to be addressed immediately. I can't tell you, we still have a single family rental in the mountains that for the last 3 years on Memorial Day weekend, don't tell me, I don't know what it is about Memorial Day weekend. We have a water issue on that property. Now we have a team in place, so we can address it very quickly. But, when you're hoping to be spending time away, on the holiday weekend with your family and friends, to continue to deal, with those type of issues can be exhausting. And then termites, right? Maybe you can eliminate that problem by investing in different areas of the country where you're not dealing with termites, but those can be very destructive problems. And then just what happens if the tenant doesn't take care of the property. Now, when you invest passively, you don't necessarily eliminate all of these issues, but what you're doing is you're putting in a professional team that can handle these issues for you. And they're not coming to you on the weekend to say, hey, we had a tenant turnover, or we've got a water problem on the property, or guess what? Tenant vacated the property and left a bunch of trash. Your position is passive, which kind of can take that load off of you, that operational load off of you. Now, why focus on complementing or even navigating, making this big shift from active to simplified assets? Okay, this type of leverage gives you a return on your time. Okay, and when you have a return on your time, you actually get a return on your attention. So if you're a high net worth earner, or maybe you have your own business, or you're a solo practitioner like a lawyer or a doctor, engineer, or something like that, now you can go double down your efforts on what it is that you do best in order to and still leverage the power of real estate. Okay, that's what we all want. We want to be able to not only step into what truly lights us up from a purpose level, but what do we do best? Go spend time doing that. And then how can we take advantage of real estate to build our capital position, our cash flow position, our equity position, and take advantage of those amazing tax benefits? Now, this is leverage. And what is that? What do we want to look for in this relationship in simplified assets? Well, it's all six of these things. We want to make sure that we are looking for, a team that has knowledge of the strategy, the market, underwriting, lending. They have expertise and track record in that business, in business systems in that field. They've got a team of brokers, property managers, lenders, legals, accountants, all there to support the running of this asset. They have the ability to access credit and lending and secure the loan. They've got the bankroll sheet to be able to do that, right? I mean, for a lot of these, what we call simplified assets, you now don't need $80 million to go access, a loan, or $20 million to get an $80 million loan on a multifamily building. We can now pool investor capital, and the operator can go secure that loan, right? And also, that brings up the last point, is that operations team has the time to put into underwriting, completing due diligence, and running the deal. Okay, many of you here are still saying, Whitney, that still sounds like syndicated assets. Yes, and there's other ways to do this, because I want to make sure that I show you different ways to invest in simplified assets, but not just to give you options, but to help you level set the pros and cons of each one of these options, and why I still stand behind investing with strong operators is one of the best ways to diversify your portfolio in this type of market. So let's take a look at our other options. Okay, if we're talking about investing in simplified assets that are going to help us create that leverage in our life, they're going to give us back that return on our time and attention. There's several ways that we can actually do this. But again, each of these has pros and drawbacks to them. So one of the first ways that you can do this is simply to go and invest in the stock market and find a mutual fund or an exchange traded fund, an ETF, that invest in real estate securities such as stocks of real estate companies, or REITs. And we'll talk about REITs here in a second. Or in the case of an ETF, you're investing in that exchange traded fund that actually tracks the real estate indices or baskets of real estate related securities. Okay, so you can either be in the fund, or you can be in a vehicle that actually tracks these indices. Now, I talk to hundreds of investors every single year, and a lot of them are coming from these type of investments. Now, there's some real perceived pros. One is the perceived pros that you have liquidity. Meaning, if you need to take that capital out for any reason at the end of the day, or maybe even in the case of an ETF, you could just hit the sell button and liquidate your position, right? And that these mutual funds and ETFs actually offer you a sense of diversification with one placement of an investment. Okay, that's a potential pro. Now, the con here is that you're in the stock market, okay? And there's a lot of volatility, and these type of assets are highly correlated with the market. So if the market's going up, maybe they're doing well, but if the market's going down, they also react according to in correlation with the market. Another con is you generally don't get the tax benefits. You have taxation of dividends that pass through. So you're not necessarily getting all the tax benefits that you would as if you own the real estate directly or were in a partnership as like a syndication. And there's a certain capital gains requirements that happens here, because some of these mutual funds and ETFs are set up to where they have certain distribution requirements if capital gets returned to the mutual fund, or if that ETF tracks an investment that gets capital returned. Now, that brings us to, okay, we've got the mutual fund. We already say some of these mutual funds and ETFs actually invest in real estate companies and in REITs. So what is a real estate investment trust? What is a REIT? Well, REITs are companies that own, operate, and finance income-producing real estate in various sectors, such as commercial or residential or industrial. Sounds very similar to a syndication, correct? Now, these REITs are set up and structured much differently than you would going into an actual partnership with a syndicated asset. Okay. Now, we're not going to get into the way that this is all structured, but let's talk about some high levels pros and cons to investing in REITs. Now, if it's a publicly traded REIT, there might be some liquidity there. Okay, there's a couple of tickers that I can think of that are actual REITs that you could potentially get out of the market in under a week or 2 week timeline if you wanted to. Okay, so but I mostly largely say perceived liquidity, because a lot of these REITs are actually private REITs. meaning you invest in the REIT, you are locked up until all of those assets in the REIT unwind. Okay, so you might go in thinking, hey, I can get my money out at any point in time. That might be the case, but you're going to be taking, you're either going to have to wait until those assets unwind, or if you do try to sell your REIT shares on an exchange market, you're going to be taking a heavy discounted loss in order to do that. All right. There's also that's one pro that I actually kind of spun as a con. But another con is that or challenges here that REITs have is that, again, they oftentimes are very volatile in and of themselves. There's high market correlation here. Again, a lot of the REITs, depending on how they're set up, you're going to have a taxation of dividends. And just like the mutual funds or ETFs, you're going to have a distribution requirement. Now, here's the thing. The reason why these pros and cons are very similar is because the mutual fund and ETF, just generally, they're investing in REITs. Okay, so they're tracking those type of investments. That's why they're so similar. So that brings me back to kind of my 7 pillars of wealth. All right. If there's multiple ways that we can invest in simplified assets where we're getting back our return and our time and our attention, how can we measure, or give ourselves like a little kind of checklist, due diligence checklist, to understand on which assets we want to consider for our own portfolio? Well, I particularly want to make sure that I'm investing in a asset that offers capital preservation, okay, that offers cash flow, equity growth. All right. Now, a lot of those ETFs and mutual funds might do that in some form or fashion, but a lot of them have trouble with that tax benefit piece. Right. And that's huge when it comes to real estate. Right. That's one of the reasons why so many of us love real estate, is that we can use depreciation, and moreover, accelerated depreciation, in order to shelter our income from these assets, essentially accelerating our velocity with our money. All right. Now, also, inflation hedging, we want to be in assets to where, not only can we use the loan to lock in, our number one greatest expense and let the devaluation of the dollar erode that loan value, but moreover, we can pass through cost increases and expense increases, or income increases and expense increases to the as things rise, we can pass that through to the end customer. We also want to be in assets that use smart use of lending. And more importantly, when I'm thinking of ways that I can actually hedge my wealth, safeguard my wealth, I want to make sure I know who that operator is that I'm investing with. And I lose that type of transparency when I'm investing within a mutual fund, ETF, or a REIT. So when you invest passively, you only get to control the operator, the market, and the deal. And I lose some of that control when I invest in a mutual fund, ETF, or a REIT. Control that I want to make sure that I have. All right, so now again, those two are very viable options. The mutual funds and ETFs and the REITs are very viable options when we're thinking about investing simplified. But if we're going to actually use our checklist, our 7 pillars of wealth, what are some other ways that might help hedge this? Well, another assets in there, investment vehicle would be investing in a real estate crowdfund. These crowdfunding platforms allow individuals to invest in specific real estate projects alongside other investors. And the projects are typically managed by professionals, and you get to choose the investments that align with your preference and your risk tolerance. Now, the pros to this is that there's usually lower minimums if you go through a real estate crowdfund. However, the cons are there's sometimes limited tax benefits that are passed through. Okay, there's generally high platform fees, and sometimes the operator who's running the deal isn't present. So this real estate crowdfund technically can check those 7 wealth pillar boxes, but I would say it doesn't do so in a very strong manner for me. And then you get into real estate notes and private lending. You can invest in real estate by providing loans to other real estate investors or developers. Now, the pros is that you can create immense amount of leverage within your portfolio, getting that return on time and attention, and maximize the 7 pillars of wealth. but you're not getting all 7 pillars, okay? Because there's generally no equity with these type of deals and no tax benefits with these type of deals. Now, I love blending real estate notes and private lending with what I consider the truly simplified way to invest in real estate, which is through a real estate partnership or a syndication. Okay, by joining a real estate partnership or syndication allows you to pool your money with other investors to collectively purchase a real estate asset. And that operator, professional manager oversees the property, sparing you from the direct involvement. Now, the pros here is that you get an immense amount of leverage, transparency, because you can actually see the operator. You can ask all of those questions. You guys have a great due diligence list. You can actually ask all of those questions directly of the operator in order to hedge your risk. You can't hop on the phone with the fund manager of a mutual fund or the ETF, or probably the operator of the REIT. You can't do that. So puts an immense amount of control back in your hands. Now, the drawback here is that you must invest with a knowledgeable operator in the right market and in the right deal. Okay, but that's what you wanted anyways. All right, just wrapping up here, guys, before we open up our Q&A section. All these approaches will allow you to invest in real estate while avoiding most of those headaches associated with property ownership and management. But make sure that as you go through that list, you're making sure that you're conducting a very thorough research and consider your investment goals, your risk tolerance and timeline, and your financial situation before you commit to a strategy. And most importantly, consult with your team to decide on which strategy is right for you. Guys, thanks so much for hanging out with me today. If you want to learn more about investing simplified, investing in partnerships and syndications, join me on passiveinvestingwithwhitney.com. I got some great goodies for you there and would love to answer your questions.